Hi, Lee Phillips here again. I want to talk about how long do you save your tax receipts, your tax records. The IRS can audit you up to 3 years from the time that you file your taxes, sort of. If you file your taxes in January and they're not due until April 15th, then they have 3 years from April 15th. Now, if you extend and you don't file them until later in the year, then they have from 3 years from the time that you file. So it's either from the time the tax should have been filed or from the time the tax actually was filed. They have 3 years to audit you. You need to save your records at least those 3 years. Now, don't be tricked, okay? Because you're filing last year's taxes in this year, but you don't file until August, let's say. So it isn't 3 years from 2021, for example. It's 3 years from 2022, August, when you actually filed the return. So don't be tricked by thinking, oh, I'm filing 2021 taxes. I don't have to keep them just 2022, 3, 4. No, you've got to keep them longer than that because it's from the time that you actually file the tax. That's 3 years then. Now, there are other issues, and that is they can always audit you forever if they allege fraud. Now, you're not going to do fraud, so we're not worried about that. We're worried about the 3 years. But you may well be a real estate investor. And if I am filing Schedule E's and doing real estate stuff, I really need to keep those tax records forever. Because if I rent the house for 5 years, I rehab it, everything else, I do it for 10 years, and I sell the house. Well, I have to go back and I have to be able to prove that I put improvements in and that increased the basis. And so when I sell it, I really don't have that much profit because I increased the basis from what I bought it at. And how do you know what you bought it at? You need to save those records. So with real estate, you need to save the records basically indefinitely. What you're going to do is you're going to scan the receipts and the records. On the real estate, you're going to scan the mortgage statement for the year. You're going to scan the insurance statement for the year. You're going to scan all of the receipts for the repairs that you made. You're going to scan all of this stuff, keep it in a file, such and such an address, 1998, and put the receipts in there. In the scanned file. Now, the IRS will accept scanned receipts, just like they accept regular receipts. In fact, it may be even better because your regular receipts are going to fade over the next decade or two while you're waiting to sell this piece of real estate. So go ahead and scan them, keep them in an electronic file for that property on that year. And then you can go back when you sell a piece of property and easily bring everything back together, see what your stepped up basis is, how much you've depreciated the roof, because the roof is under a different depreciation schedule than the general structure itself because you put a new roof on and it started a depreciation schedule for the roof over its class life. So real estate becomes a little more iffy. Standard stuff, 3 years, and real estate, I'm going to say you need to keep it forever. At least until you sell a house and 3 or 4 years after that, because they can audit you for 3 years after you sell the place. So keep the real estate receipts, keep them scanned, and you shouldn't have any problem. It doesn't take up a lot of space to store a scanned file, and you should be able to get what you need out of it. Now, don't forget to subscribe, hit the bell, ding us, love us, whatever you do. Oh, and by the way, make sure that you get my 10 tax tips. There's a link. Just go to the link and order up the 10 tax tips. It's free to you. Don't worry about it. And I've gone through and figured 10 ways that I think you should be able to lower your adjusted gross income, not by $15 by $15,000 if you're making $100,000. So this is good stuff, guys. Get the 10 tax tips, and we will see you next time.